There's only two ways out of a private mortgage. You can refinance the property or you can sell it. That's it. We are the last stop. Private mortgages are the last stop. Some people think if I have no credit, I have great credit. It's not true. A lot of people come to us and they say, what's your maximum loan amount? I'd like to apply for that. But we don't look at what a borrower wants. We look at what a borrower needs. The longer you go in private and the more money you owe in private, the harder it is to get out. Okay, welcome back to The Wealthy Lender. This is episode 21. Can't believe it's episode 21. I'm Chris Nichilo, licensed mortgage broker, financial literacy advocate, and founder of Magnetic Capital Group, which I think is Canada's premier private mortgage administration firm. And today, we're going to break down one of the most important principles, I think, in private lending. It's one that guides every deal we structure and every risk that we're assessing. And here it is. There's only two ways out of a private mortgage. You can refinance the property or you can sell it. That's it. No matter how complex the situation, every loan eventually exits through one of those two doors. And so in this episode, I'm going to show you how smart lenders build deals around that reality and what happens when borrowers don't. Hey, Nick.
Hey. Okay, only two ways out. If I had to guess, I think your favorite was refinance. The one that you would strive for.
It's not necessarily well, it's funny you say that. I don't know that it's something I strive for because I would be happy with and comfortable if every borrower came to me and said, I know I have to sell this property. I just don't want to do it under duress. My mortgage has come to its maturity with the current lender. They're not willing to renew, so I need another solution for a short period, 12 months. I'm going to sell it, and that's it. Well, that's a very defined exit. And
I see.
And what's really nice about the sale path, and we might as well start there now that we're here, is that the sale path is very predictable. And to give somebody a year to sell the house really does allow them to properly set it up to achieve its highest value in the market, right? And even if you needed to take 2 or 3 months to do some cosmetic improvements or renovations in the property in order to get maximum value and exposure on the market, you can do that over the course of a year. The problem with every deal being a sale at the end is that it might cause a problem in the market itself.
Yes, market itself. Right. But we've had so many conversations where people are attached to their homes, they don't want to let go, and in my mind, I'm thinking, if they want to refinance, and Chris is like making it possible, putting the pieces together to make the credit score, get a little boost and stuff. I figured it was like the frictionless experience of the two.
Well, okay, so let's look at the refinance, right? Because look, at the end of the day, the sale is simple. And I will come back to it because there are some nuances that I want to touch on. But the refinance, okay, is typically the strategy. And here's how I want people to think about it. We are the last stop. Private mortgages are the last stop. So if your journey was that it took you years to save up enough money for a down payment and get into the market, and you did that and everything was going fine, but something happened, something changed. And suddenly you can no longer afford the property you're in, or, you just, something is wrong and it's forcing you out. There comes a point where the only potential solve for your problem, the only way to remain in the market is by accessing the equity in the property.
Right.
And if a bank won't allow you to access it because you don't qualify inside of their very narrow box of guidelines, then you have one option left, and that is private. Because the beauty of private, although there is no such thing as a cheap private mortgage, that's why investors love it. The one caveat about private is that the private lenders make their own rules. So there is no narrow box per se. You can actually evaluate on a case-by-case basis and make an individual structure for every mortgage you do. So it gives you an opportunity to refinance. So you refinance with a private lender. But once you've refinanced with a private lender, right, then the only other option is to refinance with a B lender or an A bank, right, an institution, which requires things to change in reverse, right? So things changed and sent you down this path where things are difficult. You need the equity to be the solution to allowing you to stop that bleeding, mend the wound, and turn the vehicle around and head back towards building equity.
Right.
Okay. So if we know this as private lenders, then we ought to be looking for scenarios where that exit is viable. And we can do that because we know what the bank guidelines are. So you can look at an application, you can say, is there a structure, right, that would allow for this person to qualify at a bank in 12 months when they don't today?
Does that happen where you get a file and the exit plan is a refinance and you're like, chances are this is going to end up in a sale?
Well, we decline 8 out of 10. So yeah.
Yeah.
Right. And remember the three key criteria for us. Number one, the collateral. So we look at the collateral and say, could it set us free if we get everything wrong, or if everything changes the second after we advance the money? And then there's the ability to pay. Can the borrower actually get to month 12? Can they afford these payments month after month? And if they can do that, then the exit. Is the exit viable? So you look at two paths. Could they exit through refinance? Ideally, you want them to have both options.
Oh.
Right? Ideally, we want them to have a refinance option. Of course, we always have the sale option.
Okay,
the sale
so
option is a constant. It's always there. It's the fail-safe, right?
Yeah.
In fact, it's the exit we would use in enforcement.
Yeah. Understood. Same. So at month 9, if something happens, I don't know, the credit goes sideways for whatever reason, refinance is no longer viable, you're happy that you had that sale option in your back pocket the whole time. The only difference now is that the borrower, if they're really attached to the home, then the plan deviated from its original.
You got to start with the end in mind. So when you're underwriting, you have to start with the end in mind. You're looking at the refinance path first because you know the sale is a constant. So does this person figure to qualify? So typical scenario would be this person has a number of debts. And when banks evaluate those debts, they take a minimum payment for each one and add it to your essentially to your monthly expense load. And then they compare your monthly expense load to your monthly income. And they've determined that only a certain percentage can be allotted. In order for you to qualify for this mortgage, only a certain percentage of your total income, your net income, and they do calculate it in gross terms, but essentially it's your net income, can be allotted to your mortgage payment, your property taxes, your heat.
Is that what TDS is?
That's GDS.
Okay, what's the difference?
Gross debt service ratio. Okay, so GDS only looks at the mortgage payment, the property taxes per month, and the heat per month, the costs to run the house, essentially.
Okay. Yeah.
Against your income. Then you get a little boost on that number. You can take a little bit more and allot it for servicing your debts, loans, leases, lines of credit, credit cards, right?
Right.
So if you have a whole bunch of debt spread across a bunch of credit cards or whatnot, the minimum payments on that are going to drive up your TDS ratio, total debt service ratio. If that exceeds the limit for a traditional A bank, then you've got to go to a B bank, which has expanded ratios. So they say you can go a little higher.
Okay.
Okay. But if you exceed theirs, you're into private. Now you might say, well, if we've exceeded the bank ratios, aren't we crazy to go any higher than that? The difference is we're trying to make a change. So if we can, today you come in and your debt service ratio is here, but we can consolidate some of that debt, put it into the mortgage where the cost per dollar lent per year on a minimum payment basis is cheaper in the mortgage, much cheaper than it is on each individual debt. then you can bring that debt service ratio into a manageable place. And provided that the borrower doesn't do the same thing they did before and run up the debts again in the 12 months, you should be in that position 12 months from now in a better position to qualify. And we can kind of run those calculations and get a sense.
Can you decide or enforce how the borrowed money gets spent and which like cash flow gets freed up?
Well, we can agree to terms and conditions.
Okay. Are they sending you like credit card statements and proving that, they're paying it off every month? And
well, I mean, it depends how much control we want to have. If we want to have a tremendous amount of control, we just insist on those debts being paid and closed, right? The risk of closing all the trade lines is that the credit score tends to go down, not up, with less credit.
Okay.
The credit system likes to see that you have credit and that you can responsibly manage credit.
Yeah. So that's why I was asking about the payments, since you don't want to clear it.
Yeah. Some people think, if I have no credit, I have great credit. It's not true.
Yeah.
Okay.
You have to prove that you can spend responsibly.
Yeah. So you're going to look at the refinance path first, and you're going to see, can I take the circumstances of this person today and reconfigure them utilizing the equity in the house to do some things, pay some debts, do some things and turn the vehicle around, get it pointed in the right direction. Can you do that? If you don't know for sure, lots can change in the 12 months. People have to understand that. So again, you could think that it's viable today, but things change. Interest rates went crazy, went way up, and now now they don't qualify anyways. So you can get stuck. And if you evaluate in private the same way you would with a bank, you'd never write a deal ever. So you have to acknowledge that you're dealing with a set of circumstances. That's why they're in private. That's why they're coming to private. So you're willing to deal with those circumstances, and you need to be very good. And Magnetic, we really are very good at building structures that take into consideration. So when you say, can you really make it so that somebody has to pay their debts or not? It's a big part of what we do is saying to somebody, hey, we're happy to lend you the money you're asking for under these conditions.
And when you say Magnetic has structures in place, are you talking about buffers where, they would have to pay off X percentage of the debt, but you guys give yourselves like more leeway in case they need to sort of slow down? Is that
such a great question? A lot of people come to us and they say, what's your maximum loan amount? And we say 80% of the value. And they say, okay, well, I'd like to apply for that.
Uh-huh.
Yeah. Keyword, I'd like to apply for that. But we don't look at what a borrower wants. We look at what a borrower needs.
That would raise red flags for me. Like, what's the maximum? You hear the word maximum.
It doesn't, because it feels good to get the maximum and clean up my whole mess, right? I got this little mess. It happened because of this or because of that or whatnot. Everybody has a story. It's no problem. Things happen, right? Nobody needs to feel ashamed about it or anything. Stuff happens, but it's our job to look at, for your sake as the borrower, what's the least amount we can lend you in private funds that cost way more than everything else? What's the least amount we can lend you to get the boat turned around and headed back to the bank?
Yeah, you mentioned that in the past, that sometimes borrowers don't even know that if you service up to, 25% of the credit card limit, that's enough.
Yeah.
You don't need the whole thing.
It would feel so good, though, to look at all your apps and see that every credit card app you have is a zero balance.
Mm-hmm.
Would feel amazing. But it would also make it more difficult to go back to the bank because you're still carrying more debt. You want to carry as little debt as possible. Remember, the ethical side of this is that we're trying to put together win-win. Great investment for the investor because it's making a premium yield on, what would fit in the fixed income class of your portfolio, which means it's some of the safest stuff you own. And it's also now some of the highest producing at the same time. It's the win-win, best of both worlds. So it's great for the investor, but only if the borrower can go back to a bank.
Only if you lose them.
because the longer you go in private and the more money you owe in private, the harder it is to get out.
Okay.
Yeah.
So that's
Okay.
refinance. Did you want to touch on the sales side of things?
Yeah. On the sales side, it's really straightforward. Sometimes we have to have the courage to say to a borrower or to their broker, hey, your refinance strategy is not reliable. It's not viable. It's unreasonable to expect that you will be back to a bank in 12 to 24 months. You should sell. And if you did, all your problems go away. You don't owe anybody anything. You get to put some money in your jeans, right? And if you don't, and you end up in default at some point, you're going to erode the equity. You're going to erode it in fees and interest to private lenders year after year if you can't get out. And then if it ends up in default at some point because you get over your head, you're going to lose even more to lawyers. So we have to be able to sell people on the idea of the exit being a sale. And when we do, we have to put some safeguards in place to make sure that they are committed to it. Now, here's what we know, and here's the dichotomy, and it's nobody's fault. And we should never be upset at a borrower for being emotionally attached to their home. Okay. So if we don't put any boundaries in place, when the borrower says, you know what, I think you're right, we've run through all the numbers together, and it now looks desirable to sell, because although you don't want to get out of the market, the idea of putting a couple $100,000 in your pocket and being rid of all your debt problems and starting fresh can be very enticing. So when we get somebody to that place where they're willing to sell, now we have to put some boundaries in place, because the challenge you'll run into is, I want to sell my house, but I have a number in my head that I want to achieve. And that number is almost always, I should say it's always, higher than the amount it takes to pay the mortgage off.
Right.
And that's our interest.
Yes.
We only need an offer that's big, like high enough to pay the mortgage off. With all due respect to the borrower, it's not our concern how much money they walk away with. So you have a problem, because all is well and everybody's cooperating until the only offer that comes in, is high enough to pay the mortgage off, but not high enough to put in a lot of money in the jeans of the borrower. And so at that point, we don't have any legal right to enforce, to make them accept the offer. So you have to put some boundaries in place to address that ahead of time.
With speed being the priority, isn't it also in the borrower's best interest, because every month that goes by is more interest being, tacked on to the balance owing?
Yeah.
So, even if they do get a slightly bigger sales price, 3 months down the road, you're still accruing 3 months worth of interest.
Yeah.
So
yeah, but they don't do that math. Most people don't do that math. But you're 100% right. I mean, like, there's a time cost, right?
Yeah.
So, like, to wait for another month for another better offer, it's going to cost you X men of thousands of dollars in interest to carry the mortgage for another month. So how much real extra are you getting? Now, again, these are things that you can talk about up front. But going in, the point is, we can wrap up with this, is going into any private mortgage scenario where you receive an application, you're starting to look at this and consider whether or not you want to enter into a loan. You want to look at both exit strategies and ideally have both available. If the refinance is not available, then you want to structure a sales strategy. You want to become partners with the borrower and align on things like, who's going to be the realtor, what's the date we're going to have it listed by, right? And what is the price that if we get an offer at or above this price, you're going to accept it. So all said, the moral of this whole episode is, due diligence is not just looking at the borrower's income and employment and looking for this great fit, and it looks on paper like everything's going to be great. You have to look at the end. What is the end? To what end are we trying to structure something? What is the plan? Or is there a plan? Or are we just, we're just giving you money? and then talk to you in 12 months and hope you give it back.
Hope is not a strategy. No,
Right.
the two things that come to mind when I see, when I first saw the title, there's only two ways out. As an investor, the first thing I see is there's only two ways you're getting your money back.
Exactly.
Yeah.
Exactly. I mean, the more work you put in up front to structure the exit, the more likely it is you're going to get that money back on time. Now, good news about private lending, you're probably going to get the money back anyways. It's just a matter of, it's not a matter of just getting it back though. It's getting it back on time. The ideal investment experience for a private mortgage investor is I give you the money, you give it back in 12 months. Don't get caught thinking, oh, I can renew this thing for 4 or 5 years. Sure you can. But ideally, you would like to take it back and lend it to someone else. Take it back and lend it to someone else for two reasons. You're not the only person involved here. There's a borrower involved. They're a person too. And we're not trying to take advantage of people. We're trying to bridge them from a time where their circumstances were preventing them from getting the best available finance terms that we all want. Right? They're forced into private for one reason or another, and they're trying to hold on to their home, which as a human, I know how hard it is to get into the home, like into the housing market. You want to help people stay there. The market wants us to help people stay there. So we have this ethical responsibility to the borrower as well, and we should be very grateful to them. We need them because the returns are really good.
Certainly
it's a great investment. So anyhow, all that to say, exit needs to be planned and structured. That's the message I want to leave with people. You need to plan and manage and structure your exit strategy. It can only be one of two things, which is the great news because you only have to look at two paths every time you're evaluating. And if you can't see a clear path to refinance, then you must have a structured sale exit in place, or else you're putting yourself at risk you don't need to take.
Only two ways. Understood.
That's it. Good chat. Until next time.
Time.
Happy lending.